Is this the slide, Toller? Okay, so in which cases would we take the PBS PSS? Well, if this was pulling back, and let's start from the far left. If the far left one was in an uptrend, right, and we were getting this more climactic move lower as the wide range bar was expanding, right, we would have to see whether or not we're into support. Right? If we were into support, I would then start looking for an inside bar to set up here, a potent reversal. And if I didn't wait for that, what we could also be looking to do is wait for a double bottom, retest pattern. So this is one scenario in which we could be looking for the PBS, is if this was pulling back into support. However, if we were in an uptrend and we were getting this kind of pullback, I don't like it because it started from this wide range bar down. As it says here, momentum's just slowing, but fear is not extreme. So this one I would not buy the PBS. And so the same is true for these two. The middle one here, we've got a wide range bar up. We'll assume this is in a downtrend, so it's a wide range bar up off the low. I don't like this as a PSS. And I mean, really, we haven't had a signal yet to be thinking short, but let's just assume, for sake of answering the question, that we got a signal up here. I mean, we could short it, but I'd be looking for maybe a retracement down towards the 50% area because of that wide range bar off the low. But in this example, we have greed increasing, getting extreme. And if we're into resistance, I'd be looking for the inside bar or the potent reversal down, any type of bearish pattern, a double top, however it would form. About the taking out of well, Dan, with taking out support and resistance, let me just go to that section. With taking out, I'm looking for a slide here to use, but with taking out support or resistance, right, we have to close above and below that area. So it's not just, if it does it by just a couple ticks and then it snaps back up, and it fails to close below that area or above that area, then it's really not valid. So we really want to see that it's very clear. Like I said, I'm trying to look for an example here, but not having much luck. I mean, general idea that we're talking about is that here, you should be able to see this slide now. Can you guys see the slide? I want to make sure it's not still changing for you. Okay. So, this right here, I'm marking off our area of support. This is our area of minor support because we have a sideways consolidation and then we break higher. So this becomes an area of minor support. We trade up above it, right, and we close decisively above it. Then prices retrace. Right? On this bar right here, we don't have enough information yet to say that we've taken out support. Right? We're right into the bottom of that area, but I'm not willing to yet say that we've taken out that support. Once we get this bearish bar down and we close below it decisively, that's when I am willing to say this has been dealt with. Because in theory, right, we could have easily taken out this bearish bar's low, right, and instead of getting a wide range bar down here, we could have gotten a bar that began to move lower and then snapped right back up with a bottoming tail. And so, while it would have traded below that support, it would not have closed below it, and therefore it would have still been a valid reference point where buyers are stepping up. Right. So, with support and resistance, as you mentioned, it's an area. So we have to mark off that area, and the deeper the penetration and close into that area, the more bullish or bearish, depending on which situation it is. It's not until we can close below the bottom of that area that we can say it's been dealt with. If that's not clear, I'll continue to look through as we go through today. I'll make sure that I point these things out. I'll if I see it, I'll point it out. I'll say, here we have an example of this, or this is where we pushed below it, but we didn't close below it. So I'll like I said, as we go through here today, I'll point these events out and reinforce it to drive home the concept. The other confusing factor is that sometimes there are several pivots. Yeah, if there's a more significant area, for example, over here we have a couple pivot highs. So as we moved up, then we start to chop around here. And exactly what you said is taking place. We're absorbing the supply to the left. We're absorbing the supply from the prior weakness. So when we have a situation where, like we have here, the market comes up into a prior resistance area, and we begin to see it consolidating as it is here, this is bullish. Right? Why? Because we came up from a double bottom. Right? We then had a pullback and a second higher low formed with a strong move up, pushing deep into this prior resistance. Well, we don't erase this yet. I'm just gonna remove this for a moment. Right? The top of this resistance, right, I'm just going to extend this line here. The top of this resistance is here. Okay? We came right into the top of that resistance. So, as we discussed in the retracement section, one of the things that we need to pay attention to is how deeply we push into a prior support or resistance level. Right? The deeper the penetration, the more likely we are going to be able to overcome that area. So as this moved up, right? As this moved up, this really is our area of resistance. Right? This area here between these two blue lines. The top is here. The bottom part of the range is right here around where the breakdown took place. So, as you can see, we pushed all the way up to the top of the area. So this is a very bullish level of retracement. And as we pushed up into this level, buyers began to step up and we start to see a consolidation here. So we do take note of this area. Right? We are definitely aware of it, but we have to see how it's dealt with. Right? We recognize this as resistance, and then we have to see what the reaction is. Right? We do our bar by bar analysis. We have a red bar here that breaks lower, but then the next bar is a bottoming tail. We have a bearish bar right here that doesn't follow through. We have a bearish bar here that doesn't follow through. So as we look at this and say, okay, well, we're into resistance now, but bearish bars are having no follow through, it's valuable pieces of information that are telling us buyers are stepping up. Right? And also considering what preceded it, we, like I said, came up from a double bottom, pull back, higher low, and deep move into this prior congestion. So one of the things, where did I just go? Hold on. One of the things that I want you guys to take out of your manual and put it next to you is this slide right here, the last slide in the support and resistance section. What is the size of support in relation to resistance and vice versa? What's the distance between them? How far to the left is it? How deeply have we pushed up into that area or that reference point? These are all questions that we need to have answered so we can more easily decide on the significance or lack thereof of a reference point. Just lost my slide here. There we go. So as we look at this, right, the fact that we came up from the double bottom and this pullback, which set up another buying opportunity, this tells us that buyers are much more confident, and so the prior weakness over here is not really something that I'm considering anymore. Why? Because the strength that preceded this move up is more relevant than this move down. Right? We don't want to get stuck in the past, right? Our rules say that once we have a double bottom, right, a double bottom says we're no longer in a downtrend. So the strength, or rather the weakness here, is no longer something that we want to be concerned about. And then, like I said, we take note of this resistance and just analyze the depth and levels of penetration, and then how much do we react to those areas. So that kind of leads me into Tom's question about creating support or resistance. Just catch this. So the resistance at the top of the congestion. Correct. It's still valid as a reference point of resistance, right? But I would be willing to buy a breakout if we saw a bar that was able to come up to the top of the range, consolidate, and close up near its high. I would be willing to buy that breakout because we've got void to move higher. We've already absorbed the resistance to the left, and the move that preceded it tells me it's okay to be looking long. But until we break above and close above this resistance, the top of this blue line, this is still a valid reference point. Now, with Tom's question about reviewing where a market makes its own support or makes its own resistance, we have that right here. After this fluid move down, it leaves a void above. And as the market tried to retrace right here on this green bar, it had no follow-through. As it tried to retrace up again, no follow-through. Bottoming tail right here, no follow-through. So one of the things that we want to look for, right, after we get a fluid move down like this here, or a fluid move up, one of the things we want to look for is signs of no follow-through. If we're beginning to see no follow-through to bars attempting to move in the opposite direction, it's a good sign that the market's likely going to attempt and establish its own or create a new reference point. And that's what happened here. Because again, this move down creates a void. If this does begin to retrace back up, there's really not a whole lot to stop it from moving higher. So that's really what we want to look for, is signs of no follow-through. And when we see that, that begins to set up in our mind the idea, the thought that, okay, we're likely not going to retrace. So I need to be looking for failures to move higher to get on board. Right? So this double top will set up a failure, failed expectations. So that red bar down, we could be looking to short under that red bar down. Right? Short that potent reversal after the bottoming tail had no follow-through. And like I said, after this move up creates a void back down, the markets begin to consolidate here. They're beginning to create a reference point of support, assuming, of course, they're able to break higher. So where it's making its own support, we basically have to be looking to buy the breakout if that's how it's forming, or sometimes instead of retracing down all the way back down to support, we'll get a double bottom. Right? Prices will pull back into around the 50% retracement area in an uptrend and form a double bottom. That establishes an area of support, and we can look to take that long as well. Let me get to Newton's question before I lose it here. Traders got caught is the main theme we understand. In terms of getting caught, there's going to be situations going forward where we're going to get caught again. We want to be able to recognize when we're potentially caught to be able to get out as quickly as possible. So the idea, right, when we talk about getting caught, right, there's going to be situations where we're going to get caught, right? But we want to make sure what would increase the odds of getting caught in a bad trade. Well, one, trading against the trend. Two, taking a trade after a failure at a low or a failure at a high. Not having market internals on your favor. Trading against the larger time frame. These are all scenarios which do increase the odds of getting caught in a position. But like I said, it's going to happen. There are going to be times where even after this we get caught. But the purpose of the candle language section is to keep us as objective as possible so that when we do see signs that we may be caught, we're able to read and react to that as quickly as possible to limit the loss and possibly then take advantage of that failure, because there are going to be other traders that are not as quick and that are not as willing to accept what's happening. So getting caught in trades that don't work out is part of trading. But what separates great traders from not so great traders is their ability to stay objective and react to that situation objectively rather than emotionally. So if we see that we're caught, like I said, let's say, for example, we bought this PBS right here. Prices pulled back and we buy this PBS. It's not one that we would be very interested in, but I mean, just for sake of example, it came down from a wide range bar. There's your first sign that this is not something we want to really be considering. But even that so being the case, assume we bought this. As it started to push up and then it began to move lower, that's not what you want to see from a PBS. It doesn't take out the high and then start to come back in. If it takes out the high, it starts to move higher. So as this began to come back in, we could say, you know what, this isn't acting properly. So let me exit before it takes out my stop under this low. Right? Let me exit. I'll see how this bar finishes, and then maybe I consider taking a short, because this PBS is failing and I know that I've got room to move lower here. So again, like I said, it's really just about staying objective and accepting what's happening rather than thinking or wanting something to happen. So, what if the congestion to the left was lower? Congestion to the right was lower. Now extending to the top of the resistance. So if this was down here, so the question is, what if this congestion area or that area of sideways movement is being built up in this area where I've just drawn that line? And my answer to that is that, okay, it's still bullish, right? It doesn't change the fact that we moved up from a double bottom, right, pulled back, and we got another push higher. So if it was happening here, it's reacting to this prior high, and then we still have this general area of resistance, right, which we defined just before, this area here as resistance. So it's not as bullish because it wasn't able to push up as high, but it is still a more bullish environment. And as we consolidate, remember, we can absorb supply through time as well. Time moving sideways away from an area reduces that prior reference point as resistance in this case. So consolidations away from prior resistance are also bullish. As this moves away from that congestion area, it's weakening it. Remember that as we move away through time, traders that were hanging around here or that got on board here, as we move away from that reference point, it's not as significant. So like I said, we would still read it in the same way. It's just not as bullish because it wasn't able to push up as strong as this example we have. So yes, you'd still be looking to buy the breakout, right? Because you still have the double bottom, you still have the secondary entry, and it's consolidating away from that reference point. So I mean, it's not as ideal, but yeah, we still take it because the information that preceded this consolidation and the bearish bars having no follow-through are all more valid pieces of information than this area to the left. Right? And another way to think about it is in this way. if you had shorted this breakdown, think about it like this. If you had shorted this breakdown, are you still going to be hanging around as prices are just consolidating here? Or are you going to probably be out? Right? Regardless of how you're going to manage it. And if you manage through pivots even, when you saw this double bottom form, even then you'd probably be getting out. So the number of traders that are still going to be up in here is not very many. So think about it in that way as well. If you had gotten in here, are you still going to be sticking around as we're beginning to base sideways there? All right, so any other questions? If not, we'll get started with trader pivot lines. No? All right. Let's get started then with day 2. Get going here with trader pivot lines. And guys, just to let you know a little bit about the plan for today, we're probably, I would think, we'll see what time it is. It depends on how quickly we go through these first 2 sections leading up into market internals. But market internals is the biggest section of this entire seminar. So it's going to take some time to get through it. And so depending on what time we get done with the first 2 sections today, trader pivot lines and the opening gap, that will determine whether we go right into market internals before lunch or if we break and then come back with market internals. So, but for this morning, we're definitely going through pivot lines in the opening gap. And like I said, depending on what time it is, we'll then go into market internals. That section probably is going to take close to around an hour and a half or so to get through that entire section. Like I said, that'll be the biggest one today. So just a heads up there. But as I mentioned, depending on what time it is that we get done with these first 2 sections will depend on when we tackle market internals. All right, so trader pivot lines. Just some general concepts when it comes to trader pivot lines. Some general thoughts is that when prices are trading above the pivot point or daily pivot, it's considered bullish. Right? And when we're below it, it's considered bearish. But this can be misleading. Why? Because that does not necessarily define the trend. Right? We could be trending higher, but under the daily pivot. So again, it can be misleading to just simply make a blanket statement that says if we're below the daily pivot or pivot point, it's bearish. So we need to always consider our trend analysis. So again, we have to be more objective when it comes to everything, right? Where we are in relation to a pivot line, right? What's the direction of the trend? Right? So just because we're below it doesn't mean we want to be shorting, or we don't want to necessarily be going long just based on the fact that prices are above a pivot point. Now, once a pivot line is violated, I use the overnight, I use the 24-hour data, but they can be calculated either way. And that's what makes them subjective as well. However, while subjective, trader pivot lines are, especially with E-minis, an extremely valuable tool because so many are looking at it, right? Just like so many are looking at a 200 MA. I want to know where these trader pivot lines are. And I find that I think most are using the overnight session because I've not seen, I've not used the day session, but the ones that I use, the overnight session, and that's what the pivot line script with eSignal and the trade station is looking at. But I've not found them to be unreliable. So, like I said, I use the overnight, but there are going to be traders that will use the day chart as well. And again, that's what makes them subjective. But we're going to talk about why they're so useful as a tool that we want to be using as well, in alignment with everything else we've learned up until this point. Right? So once a pivot line is violated, right, a retest of that pivot line is possibly going to be an opportunity to fade that move into it. In other words, once we move above a pivot line, buying the pullback in an uptrend to it is a strategy that we will look to take advantage of. And if we move down below a pivot line, retracement into it we'll look to take advantage of. And anytime we can combine a pivot line with support or resistance, price support or resistance, it's going to be that much more reliable as a reference point. Now, in a downtrend, pivot lines are less likely to be a tradable reversal point unless the move lower has become climactic. So, in other words, if we're in a downtrend and prices are moving lower into a pivot line, we do not want to be thinking, okay, let me take this long. Instead, it's going to be best used for taking profits. If we are short and prices are moving lower into a pivot line, we want to consider that as a signal to be taking profit, not getting long. And like I said, once we can combine trend analysis, market internals, and pattern recognition, this is going to increase our odds of a successful trade when we combine those factors with pivot lines. We never, though, want to be placing a trade just simply based on a pivot line in and of itself. Yes, that's correct. Yeah, when I say pivot line, it's just whatever pivot line it is. R1, S1, so on and so on. But we don't want to just place a trade based on the fact that we pull back into a pivot line. And we still need a pattern. That we still need confirmation. We still need to see, ideally, if there's support there. We don't want to just say, okay, here's a pullback, and we're into the pivot line and just buy it based on that simple idea. However, we do need to understand that traders will do that. That is a style that traders will use. So knowing that, we can use that to our advantage. Now, this is just how they're calculated. Really not necessary that you see this or that you know how it's calculated, because the scripts will do it for you. There's websites that will do it for you. But if you want it, here it is. Now, in terms of how, they're calculated based on the prior day's high, low, and close. The distance between these lines, these pivot lines, are going to suggest the potential for larger moves or more choppy moves. When they're farther apart, these pivot lines, the odds for more fluid price action, more trending price action is much greater. Whereas if they're closer together, we're likely to see chopping back and forth. Especially when we've got real closely grouped pivot lines and we've got each market hitting them at different times. That is just a recipe for getting chopped up. If we have YM moving up into a pivot line and then retracing, and then the NQs at some point a little later on, then they're hitting a pivot line, it's just going to be a big back and forth choppy mess. We're also going to use what's called midpoints. Midpoints are simply that. They are points in the middle, the midpoint between these pivot lines. Right? So we're going to have a midpoint between the R1 and the R2. We're going to have a midpoint between the S1 and the S2, between the pivot point and the R1 line, so on and so on. Right? But these may not be as reliable unless the pivot lines have a larger distance between them. So on those days where we've got pivot lines spread far apart, those midpoints will come into play. They'll be more relevant on those days compared to days where we've got these pivot lines grouped closer together. And because these pivot lines are based on the prior day's high, low, and close, these are also going to be reference points as well. And as I already said, the pivot lines in one market can affect price action in another. So here is how we're going to again look at them. When prices are below the daily pivot, it's considered bearish, so movement into that will be met with selling. Right? But we want to make sure that we're in a downtrend before doing that. The pivot point is going to be near the midpoint of the prior day's range, meaning that the daily pivot is generally associated with where the majority of trading took place for that prior day. The higher the close on the prior day, the higher that pivot point will be. The lower the close, the lower it'll be. So once a pivot line's been tested, it's not going to be as reliable the next time around, because in a sense it's almost like support or resistance. Once we test it for the first time, the second, the third, the fourth test of it, it's not going to have as significant an impact on traders' emotions or the way in which they react to those pivot lines. And once a pivot line has been significantly violated, it's going to have the opposite effect. Right? So once we, for example, if we're above the daily pivot, once we move through the bottom of it, a retracement into that daily pivot will then be used as resistance. So resistance, a resistance line can become support. So don't get hung up on the wording of S1 line, meaning support, the first support line or the first resistance line. Don't get hung up on that, because if we move above a resistance line, it's then used as support. So don't get hung up on the names. Will a gap up or down destroy the daily pivot? No. The daily pivot will be there, right, just as all pivot lines are going to be there the following day, because it's based on the prior day's high, low, and close. So wherever we're gapping has no impact on where those pivot lines are. The only impact that gap has is whether we're above certain pivot points or pivot lines or below them. And if we're gapping above, let's say, the daily pivot, pullbacks into that daily pivot are going to be bought. And if we're gapping below it, retracements into that daily pivot are going to be shorted. So market doesn't need a retest if no other support. No, if we get a strong move up and there's no support, prices begin to consolidate or stall on that pivot line, and there's still a void to move higher, that is enough, correct. If we begin to see price holding that pivot line, and we're seeing, bottoming tail forming, bullish bars forming that signal a move higher into the void. That is enough, and we can't take that long. If that's the case, I wouldn't say that, because really the odds or the likelihood or lack thereof of a trend day is going to be based on whether or not there's a void. Pivot lines being grouped closer together, I mean, if that's what you mean, pivot lines being grouped closer together, they do lead to more choppy action. You can see that here. Right? These pivot lines relatively close together led to this chopping around. But if they're farther apart, right, then you could say, well, now there could be more fluid movement between these reference points. Yeah, you could say that, yeah. And then make sure that it's in alignment with void, because the odds are going to be that much greater. Or the odds are going to be that much more in your favor. So what we're looking at here on this slide is that while we may just be trading YM, right, we want to know where the S&P is in relation to its pivot lines, because as you can see, YM here didn't have any pivot line below it, right, but it was going sideways. We look at the S&P, and the S&P was down on top of this S2 line and going sideways above it. And that's what caused YM to stall. Once YM and the S&P began to break lower, right, they both did so in the same way. Right? YM, though, broke lower and followed through much easier, much cleaner, because it had more room to drop. Then YM came down, and it pushed just below this S1 line before it started to stabilize, and the S&P also started to stabilize. Okay? You look here, the S&P retraced up into this aqua line, which is yesterday's low, and also resistance to the left, and that's where we got this move down. So here we have a situation where we push up to the top of resistance, but we never take it out. So because we never took it out, it's still a valid area, and it did lead to a more significant move lower. Now, what pattern is this? What pattern that we discussed from yesterday are we looking at? My lines are a little off there, but right, bear flag. Right, the higher high, higher low, right into the top of resistance. The shakeout pattern, generally when we look at a shakeout, what we're looking for is a follow through to the failed attempt down. Right? But this continued to move lower. So this is a bear flag. The first lower high failed. We got a move up to the top of resistance, and that's where we rolled over. And you can see that YM really didn't have anything to the left in terms of a pivot line, or it didn't have a pivot line here, but it did put in a retest of this prior high. And knowing the S&P was at yesterday's low, it too had a reference point, so we could have been shorting either really the S&P or YM. So again, like I said, it's important that we are aware of other markets and where they are in relation to the pivot lines. No, it includes aftermarket as well. of the things that makes pivot lines, as we said, trader pivot lines are subjective. But one of the things that makes them so much more reliable than any other subjective tool out there is that no matter what time frame you're looking at, the pivot lines are going to be at the same level. It doesn't matter if you're looking at a 1 minute or a 15 minute. You're going to be looking at those pivot lines at the exact same price level. So if I'm a 1 minute trader and I look for the pullback into that pivot line and I get my signal, 15 minute traders are also going to be looking at that same pivot line and that same pullback. They're just waiting for a different signal. But we're both looking at the same pivot line value. And that's what makes them so reliable, because it doesn't matter what time frame you're looking at. Every trader, regardless of the time frame they decide to trade from, is looking at the same price level for those pivot lines. Whereas if we were to use a 13 MA on the 5 and a 13 MA on the 15, they're going to be in two different spots. So that's one of the things that makes them so valuable, even though they are subjective. So as we look at this, right, we got a strong move up. So an example of what you were just asking about, Tom, is that here's a strong move up. We really don't have any support, but we stabilize on this pivot line, and then we get another push up. So that could have been a spot, ideally off of a smaller time frame, where we could have looked to get on board, or just buying this potent bullish reversal, seeing it, assuming, of course, we've got void to move higher. We then get a pullback and PBS right into the pivot line and support. This is a spot to get long right here. If you're not long yet, this double bottom right here. And also note that the double bottom took out the pivot line low and snapped right back up, closed on its high. This, if you didn't get in the first PBS, this is an excellent opportunity to get long. I've never looked at that, Skibum. I know with regards to the euro that these pivot lines do work reliably, but I've never looked at them on gold or oil. So I'm not sure. So here's the double bottom. We get another push up, and NFT is no follow through. No follow through to these bearish bars. What might be one other reason, right? We do have a little bit of support here, but what might be another reason why the market was holding right here? All right, so there, Dan says they do work with gold and oil. Thank you. What might be another reason that the markets, or this particular market, was holding this area? It's got support, but I want you to think, yes, exactly. Another market possibly being at a pivot line. Exactly. So maybe the S&P had pulled back to a reference point, and that's why we started to see YM begin to consolidate here. And again, that's why it's important for us to look at other contracts as well. Sharp move lower. Right? We went right through that S1 like it wasn't even there. Right? This pivot line right here is the S1. We went through it like it wasn't even there, which confirms the bearishness. Right? It also leaves a void back up above. So at that point, once we establish this void back up above, right, this momentum move, we say to ourselves, okay, well, if this is going to retrace, right, I'm going to be needing to look for some double top, some breakout failure that tells me supply is increasing. Because of the void that there is back up above, the market's going to have to create new resistance. So this double top right here creates that resistance. Breaks lower into this pivot line, comes back up to this little congestion. We get a potent bearish reversal, so we can short under that bearish reversal bar's low, looking for continued weakness, right? Because here the markets have now established or created resistance. And you can see then we got to move lower, right? We move lower under the S2 line, so once we're under the S2 line, retracements back up into it will find sellers. Retracement into it, sellers up here, it moves back down, we get a range expansion bottoming tail, beginning to tell us that momentum is slowing, buyers are stepping up, retraces again into this pivot line. Again, sellers show up. We got a breakout failure. Potent reversal back down. Another retracement lower. Greater than 100% retracement here. And then we begin to just consolidate at this point. As it says here, note the angle of retracement and the bottoming tail. Every other move lower was pretty good selling. And here now, we're kind of just drifting sideways. This bottoming tail was a bearish bar prior to completion. It then begins to move higher, and we move above the S2 line now. So here is another significant event. Once we get above this S2 line, it's now going to be used for pullbacks to get long if it would have set up. But as it says, after we tested, go ahead, after we tested support, right, on this retest here and took out this prior pivot high, it told us that buyers were stepping up. Could you go long over this bottoming tail? You could. You could, because you've got this retest, right? This retest here, it made a new low, reversed back up. You got another attempt to move lower and retest here, which then pushed up and took out that prior pivot high. While it's not major resistance, this retest does tell us that buyers are stepping up more aggressively. And then this bottoming tail absolutely says that here's a long opportunity. Right? We just have to watch it closely because that S2 line has been used as resistance before. So, although it did stall there, we were able to push through. So yes, you could have taken that long. The trend at that point where this bottoming tail took place, it was still overall weak, but improving because, again, we had the double bottom, and we pushed up to take out this prior pivot high. So we were getting signs that buyers were becoming more aggressive. And then, like I said, the angle of this retracement is also very bullish. If you didn't take this bottoming tail, though, look at this right here. The little inside bar right on top of the S2 line as we got above it. So if you don't take that bottoming tail, fine. Once we took out the S2 pivot line and this resistance here, and we got the stall bar, right, that becomes your next opportunity. Right here above that bar. Oops. Yes, you can, because based on the retest, we're no longer in a downtrend, right? That's the rule. Once you get a retest, a W bottom, and we get a move up above the prior pivot high, it tells us that we're no longer in a downtrend. We're not in an uptrend yet, but we're not in a downtrend, and we can buy the next higher low. That's the rule that we established in the trend section. W bottom says that we're no longer in a downtrend, and it's okay to take a long setup if it forms. So we want to use these trader pivot lines in alignment with the trend. So as we get this strong move up, prices then begin to consolidate on top of yesterday's high. As they consolidate, we see this failed attempt to move lower. We then get another bar of stabilization. And then we get this little inside bar which closes on its high. So we want to be buying above these bars, either above the inside bar, or if you want to let it take out the prior topping tail doji bar, that's fine. But recognize the signal. This bar closed right up on its high. Is there ever a time a double bottom has formed? Not if it's, well, I mean, we can if it's a really bearish day, but what I have found is that if I'm going to short a double bottom, right, it's not going to be able to take out the prior pivot high, right? So let me go back here for a moment. You see how this pushed up and took out that prior pivot high? If I'm going to short a double bottom or a failed double bottom, it would, after this green bar reversing like this, it would try and pop up, and then we'd get, a topping tail that closed bearish and deep into that prior bullish reversal. That I would short with bearish internals and void to move lower. And I find that those work very, very reliably if they set up like that, because you've got buyers trying to create support, but they're trying to create support A, in a downtrend, and B, in an area where there's still void to move lower, and you're going against the internal. So going against the trend with void to continue moving lower, and also being against the internals, is just a recipe to lose money. That's right, Dan. Absolutely. So, again, we want to use these pivot lines in alignment with the trend. Move up, we're buying above this high. As it continues to move higher, we get a potent new high reversal. Market comes right back in. We've got void to move lower. Retracement into this pivot line. So we want to be looking to get short. And looking at this bullish bar up, that may scare some traders off from wanting to short that. But think about what this bar is on a shorter time frame. What is this bar on a shorter time frame? All right, it's a PSS. Right? It's several bars moving higher. So understand that one bar up into a pivot line is on a shorter time frame, several bars up into the pivot line and resistance. So it's okay to be shorting this, especially after the new high reversal. So don't let a bar like this scare you off and avoid taking this trade. Understand what's taking place in multiple time frames and also what preceded it. Right? This bullish bar up, right, is also forming in an area where there's no support either. So we're getting a bar up forming where there's no support. It comes right into resistance and retesting the area of the new high reversal. So there's going to be a bunch of sellers up here. You've got the sellers from the failure at the high, and you've got the sellers at the pivot line, and they're going to use that as resistance. So there's going to be a bunch of people sitting up there. Here we have on the left side, strong uptrend, moving higher. We then get a new high followed by an inside bar. We wouldn't be shorting it because we didn't have that climactic move higher, which creates the void. But the inside bar after the new high is clearly a warning sign, right? That's what we said yesterday. A new high after an inside bar. If it breaks the inside bar's low, that's a warning sign. We then move lower and break below and close below a level 3 pivot low. So we take out major support here. This retracement up and into prior resistance says it's okay to be shorted. So it breaks the midpoint, we can short that. Why? Again, because we moved lower, broke major support, says it's okay to short the next retracement, comes up into resistance, bang. Right? Next opportunity, if you didn't get on board here, was right there, that PSS. Comes down to this pivot line, stabilizes there a moment, and then you get a breakdown right here. Another bearish reversal at that point. Then we get a double bottom here and a new low reversal. Trying to take out, right? So notice here that this bar, let me do this here. This is trying to take out the high, but so far it hasn't been able to close above that prior pivot high. So sellers are still in control there. Right? And so Dan, that's kind of like what you were asking before. Here we took out the top of that prior pivot high, but we weren't able to close above it. So we know that sellers are still using this as a reference point. But, I mean, in this example, we wouldn't be looking to short it either because it came up from a double bottom and new low reversal. But that's the idea right there, is that we want to see prices move and close above a prior reference point before we cross it off. Again, same thing. Using these pivot lines in alignment with the trend. Here we have several bars going sideways, popping tails, signaling to us that supply is increasing. We then close below multiple price pivot lows. That tells us that this move is now beginning, getting ready to move lower. Get a move down into this blue line, which is yesterday's close or the prior day's close. Retracement into resistance. Bullish bar ignored. So here's a shorting opportunity right here. Bang. Move lower. Sideways on top of this daily pivot. Breakdown. There's a shorting opportunity. Retracement into this pivot line. There's a shorting opportunity. PSS. Multiple shorting opportunities. All the way down. And as it says here, as we come into this midpoint, it's okay to take profit, but we're not looking to go long. Right? Why? Because we're still in a downtrend, first of all, right? And there's nothing climactic about this at this point. I mean, there has not been a wide range bar or any kind of climactic indications at this point. It's not until down here that we see the wide range bar moving lower. That's when we're getting more climactic environment. So here's the shakeout. Move up, deep retracement into the prior support, tries to stabilize, pushes up again, lower high, and then it cracks major support. So that's the shakeout pattern right here. This idea of sideways, it breaks higher as this did, and then it comes back down, and we then get that next attempt to move up, and it forms the lower high, and then it cracks lower. So it breaks lower, breaks resistance, breaks support, retracement here, topping tails. This is a pattern where we want to be shorting. Right? After the break of major support, we short the retracement. And again, we expect a reaction down here at this R1 line, so we can be looking to take profit there. But we're not thinking long. And then we're seeing, okay, what happens from there? Continues to move lower. Right? Once we move under this R1 line, it's going to be used as resistance. So as you can see, the attempts to move up into that area of that pivot line were met with selling. No follow through to these bullish bars, breakdown, and off to the races. Now this move down creates a void. So what do we see happening right here? What's happening over here in this area to the right? Oh, you would stay short. Right? If you shorted here, you want to be looking to take some profit, but definitely holding on to some, because right, the trend, like you say, is now down, and let's assume that there's void to move lower as well. Right? So you definitely want to be holding on to some of that also. But I mean, like I said, you've got to expect that there's going to be a reaction here. And if you want to sit through that reaction and hold on to your entire position, that's okay too. To hold on to the entire position, there's nothing wrong with that either. But I agree, you definitely want to be holding on to something even after this test of the pivot line. But what's happening over here? What are these arrows indicating? Right, a consolidation. We're creating resistance, right? Instead of retracing up into the void, right, a double top. We're creating resistance. Exactly. So this says, right, we're likely not going to retrace. We're just going to begin to consolidate sideways here. So I need to be looking for bars that are closing on their low to signal that this is ready to move lower again. But I want to be looking for failures to move higher to get short. The double top was one opportunity. Here we have a wide range bar up with no follow through. It retests this prior high, double top, cracks that low, and then retraces all the way back up. So one of the things that we need to consider is the fact that after this break lower, right, if this was really weak, based on the break lower of that wide range bar and double top, if it was really weak, we would not have moved back up above this pivot line. We would have rolled over right here. We would have gotten our signal to short right here under this topping tail bar. Instead, we push up above the pivot line, and then buyers begin to step up here. and you got this bar closing on its high. So the fact that this move lower was retraced so deeply and got back up above the pivot line put that prior weakness in question. And this bar, which formed the bottoming tail and closed on its high, was a signal to consider long. And if not long here, definitely as it's sitting on top of yesterday's high, and we got this bar closing on its high here, followed by this next bar, which closed up near its high, or the following bar. And then at that point, once we enter, we look to see where's the void, where's the target, which was up around that R2 line. And so, as it says, the R2 line was the reason to take profit, right? After this move up, wide range bar, then another wide range bar up, right? Topping tail into that pivot line, we want to be looking to take profit, but not getting short. Then you can see the market's beginning to hold right in the area of prior support. It's pulled back into support, and it's beginning to stabilize. And we'll have to see if it can hold here and begin to move higher yet again. So on this slide, starting from the start of the day, we've got the first bar is a topping tail. It moves lower. Retracement back up to retest the high of the day and just under this pivot line, followed by a potent reversal down. There's a shorting opportunity. Right? This bar up is a retracement of several bars on a smaller time frame, and this provides an opportunity. We then get a move lower. Right? Under this midpoint, we get a potent reversal. So it's okay to short under this midpoint here. Then get a move lower, followed by a potent reversal, and then it leads to a double bottom. Okay. Two potent bullish reversals up now establish a stronger reference point of support. We push up here, and then this pullback becomes a buying opportunity because of the two potent bullish reversals and the establishment of the double bottom. Pulls back, support, bottoming tail, bullish reversal, right? PBS right there. This bar down, right? This red bar down, and transition into that green bar is a PBS on a smaller time frame, right? Just above the midpoint. Prices then rally up. No violation of major support.
What?
Right here? Yeah, major, well, support's down here. So right, it didn't violate any support. Well, no, it didn't take out major resistance. No, that's fine. It didn't take out major resistance, but the double bottom says it's okay to go long the next pullback. Right? Remember, that's our rule. If we have a double bottom that forms, and we've got two very potent bullish reversals, it says that on a pullback, if we see stabilization as this did, it's okay to take long. In TradeStation, Bob's in here. I believe that with TradeStation is a little different than eSignal in terms of the pivot lines. Is that right, Bob? I'm not sure if you can hear me. He may not be around at the moment. I'll look into that though for you. I think TradeStation's a bit more difficult though, but I'll look into it for you. Oh, there. So there are two versions. So as we move up here, we're retesting this prior resistance, but we don't want to be shorting up here. Why? Because the trend is now up. We're now moving higher. This pullback and stabilization here establishes support. This little double bottom establishes support, and we then go on to another move higher, taking out these pivot lines, pull back into yesterday's close, PBS, take it long, no follow through to this bearish bar, consolidates, and then another move higher into the midpoint with a range expansion topping tail, signaling that the upward move is short-term over. And we just continue to do the same thing. Here we have a weak move, right? Weakness. A fluid move down. Strong retracement back up above this pivot line. Buyers continue to step up as indicated by the bottoming tails and no follow through to the bearish bars. Then we get this bar closing at its high. That's the bar that says we're going higher. So again, even though we did not take out the top of this resistance, right, although we didn't close above it, the fact that we had such a deep move into it and just consolidated here, followed by the bar closing on its high, said that this was going to move higher. Right? So we buy the breakout, and then we just manage based on our rules. This failed attempt to continue moving higher is a reason to exit, but not go short. Why? Because the prior strength says that the bulls are in control, and we want to be looking to buy the pullback. Right? So here we have a pullback, right? Move up into that prior little congestion. This bullish reversal right here signals for me a move higher. Now you could have taken this reversal here as well. This bullish reversal here could have been taken because it failed to break lower. But I personally like this one here. It's that extra confirmation. We then go on and move higher. Again, you get a failed continuation up, which signals profit taking, but does not tell us that we want to be getting short. We then retrace, double bottom, comes back up, retest, supply is beginning to increase. Now here we have YM and the NQs. YM on the left, NQs on the right. We have both YM and the NQs at a pivot line. Right, YM pushing up here, the NQs pushing up into the R1 line. Right, they're both at reference points. So it's okay to short YM, even though it's after a move up. It's created a void based on the move higher, and it's retesting the prior high. So we've got a reference point of resistance there to the left. So it's okay to short YM after the double top and new high reversal. Up here, Well, because of this congestion area below. Yeah, that's why I wouldn't. I mean, the failure to move higher definitely says we're likely going to stall here. But being above this midpoint and having this overlap below it, I don't like it as much. Right? If we had a wide range bar up instead of these overlapping bars, if it was a wide range bar up and then an inside bar, that is something which becomes more compelling. Especially over here. If we didn't have this double bottom and it moved up like this here and we got that inside bar, that becomes more compelling. Anytime I'm going to short against the trend, I want to see that it's on a retest of a prior high. So that's why on this slide, YM, even though it's in an upward move, it's retesting the prior high and we have a new high reversal with a pivot line. So this becomes a more higher odds opportunity because we've got traders that are shorting based on the retest of the pivot line. We've got traders shorting on the retest of price, and we've got traders caught after buying the new high. So there are several groups of traders here which are all interacting at once to provide this opportunity. I would not have been looking to short the NQs because even though they were into a pivot line, there was no resistance to the left. It didn't have the same shock value as YM. But then, as we move up to this midpoint, and we retested 3 times, the third attempt being a popping tail closing down near its low on the NQs, that becomes more interesting than YM, because YM's got all this overlap down here, which is going to act as support. The NQs only have this little 2-bar combination, and that's not very significant. Now we can also apply these pivot lines for weekly pivot lines, as well as the prior week's high, low, and close. We want to use these for focal points because that can impact the longer term charts. And so we want to mark them off. We want to know where's the weekly high, low, close, where's the weekly S1, the S2. Now you can see that buyers started to step up on that weekly S1 line. So we want to know where they are as well. Like I said, it's for a more longer term view or picture of what's going on. And we read them in the same way, the exact same way. If we're above it, buyers are going to use it as a reference point to step up. If we're below it, that's going to be used as resistance. Same way we're going to use them. So if we're going to trade against the trend, here we have a 5-minute and a 100 tick. If we're going to trade against the trend, we should be doing it, right, like I said, when we've got a climactic move away from prior support, and if we're in an area of prior congestion to the left. So in other words, we want to see that there's reason for sellers to step up. Right? After a climactic move higher, we want to see there's reason for sellers to step up and drive prices lower. So here on this 5-minute, we have a climactic move to the upside, and it's retesting pre-market resistance. So we go down to the 100 tick, excuse me, and we see that, okay, here's part of that climactic move higher. We're into a pivot line, We know that there's resistance to the left, and here we have 3 attempts to move up which are failing. So here is an opportunity to get short, right, on this triple top or on this breakdown. You can see the starred points are the same spot. So when we can add to a climax, if we can add or put together the combination of a climactic move up, prior resistance to the left, and failures to move higher off of the shorter time frames with a pivot line, it increases the odds that there's going to be sellers there. And we want to be looking to take our counter trend trades under those conditions, with the void created by the climactic move, the retest of resistance, the pivot line, and several failures to move higher. That's the combination of factors I'm looking for when I'm going to take a counter trend trade. All right. The opening gap. Unlike stocks, with regards to E-minis, the opening gap is usually filled or partially filled on that same day. So there's a bias that E-mini traders have, right? Many E-mini traders have, which is to fade the opening gap. Right? In other words, fade means if we gap higher, they're going to be looking to sell short, looking for that gap to either be filled completely or partially filled. So fading is just simply means to go against the prior message. So the gap up, you fade it, is to go short. If it's gapping down, you go long, and that would be fading it. But that's not enough, right? Not enough for me, at least. I understand that that's what traders are going to be looking to do, but I also want to use prior support, resistance, the pre-market trend, the trend from the end of the day, yesterday, or the prior day, and also pivot lines. And then, of course, looking for patterns to give me the bias. So we're going to use a day chart. We're going to use a 24-hour chart, which is going to be time-based, and we're also going to look at a tick chart, right, for activity. Our support and resistance analysis will come into play, trend analysis, and candlestick analysis. So one of the things that we need to look at is how we move into a gap. They're considered reversal points. Gaps are considered reversal points, but it's not that easy to just say. Because it's how we move into these reversal points that's most relevant. Right? Just as we said with support and resistance, how deeply do we penetrate into these areas? It's the same idea. How much do we move into this reversal point? Right? How many bars does it take to get into that reversal point? Here we have a gap down, right? This gap down was never filled. This is a daily chart, by the way. This gap down was never filled. Right? As we begin to move up, right, there's no follow-through to this bearish bar down. We get a bottoming tail. Prices move aggressively into this gap with a wide range bar. Right? This is a sign of strength, right? A bullish sign of commitment. The wide range bar igniting this move indicates continuation, not that we're likely to reverse here. And you can see that that is what happened. As we pull back up here, right, several bars into this gap fill and stabilization, right, this is signaling follow through to the gap up. And we get a potent bullish reversal, little continuation setup here, and it goes higher. So it's how we move into this gap that's going to be very valuable information as well. Several bars moving into the gap suggests a reversal there, and then follow through to that reversal, whereas an explosion of one or two bars into that gap fill indicates continuation of that prior move. And that's basically what it's saying here. Several bars moving lower into the filling of the gap and slowing in momentum confirms that traders are stepping up here. It confirms that they're using this as a reference point of support in this case. So we want to be looking to get long off of either this time frame or a shorter time frame. We then move up. Prices go sideways here, gap down. We begin to move lower. Buyers step up once again in this area of the gap fill to the left. We then explode higher with an expanding range into this prior gap. That indicates strength and continuation. It tells us commitment is taking place. So one or two bars moving into a gap with expanding range tell us to be looking for continuation. Several bars moving into a gap followed by slowing in momentum says that we're likely going to see a turning point here taking place. Right, so that's the first step. That's how we're going to begin looking at these gap fills. Now when we have a wider area, it's going to be less clear. It's not just a defined point on the chart where it was easy to see on those last examples, right? This is a much wider area of resistance, so we need to be looking at that for opportunity. Right? We need to be ready for wherever this may begin to turn back down. So here we have this move higher, and we come into the beginning of this gap fill. We could definitely and want to be looking to get short here. Of course, provided that the internals confirm and all of our other analysis allows us to take the trade. But as this started to move lower, we're starting to see bottoming tails, right? We're not really getting the follow-through that we'd want to see after having a short setup triggered. So this begins to move lower, and then it comes back up. Right? Maybe we still get a retest. But as this started to just go sideways here, it told us that, you know what, this isn't working out. We're likely going to need to move higher up into this area. So that is what we got. Right? We got a stronger move into this area, and that's where then sellers got more aggressive. Right? But there's no way of knowing that beforehand. And that's why, like I said, as long as the plan allows us to, we take this trade short, and then we just manage it objectively. Right? We go bar by bar to see what is being communicated to us. As we got this move up, strong bullish bar into resistance, followed by a potent 180 reversal here, and little inside bar. Right? This becomes another shorting opportunity right under this series of bars. And then this is the kind of action you want to see. Fluid movement to the downside. Now, as you can see, this did find support and continued to stabilize there, but as I said, when it's a wider area, we don't know exactly where it's going to reverse, but when we get signals that that supply is increasing in this scenario, we need to be taking those signals and then using our objectivity to determine what's going on. Now, one of the very important things that we need to do when looking at gap analysis is determining what or how did the prior day finish? If the prior day finished with an end-of-day uptrend, there's really no support underneath this move. So the end-of-day uptrend leaves little to no support. So we've got to avoid to move lower, basically. If we're gapping down, we've got void to move lower. Right? If we're gapping up, it sets up the possibility for a gap and crack. Right? A gap up and then it just begins to fall back down. Whereas if we had an end-of-day base, that creates a more clear area of support if we gap above it, or resistance if we gap below it. Right? We have a more clearly defined area. So we need to take notice to how did we finish the prior day. Right? Same thing with weakness. End of day decline leaves little to no resistance above. Whereas the end of day base clearly defines an area for us. So we need to see which way are we gapping. Again, with the end of day decline, if we gap down here and then we begin to stabilize, that sets up a potential gap and snap. Whereas with the end of day base, we're looking to see, do we break below it, do we break above it, and then we have a reference point of support or resistance. So it's important that we notice this or realize how the prior day finished. So on this day, we've got a sideways end-of-day base. So a gap above this will be support. And so on a pullback, we'd be looking to get long. If we gap below this area, we have resistance. So the gap down could be faded or bought, and then we're looking to see, are we getting signs of increasing supply, and if so, we're looking to short it. And then we're going to use, of course, our other concepts in trend, support and resistance, pivot lines, so on and so on. Now this end of day decline creates a void back up. And we're also beginning to see at the end of the day, on this particular day, a potential double bottom forming. So if we got a gap up the following day, there's really little to no resistance overhead, right, depending on where we're gapping. Yeah, we do have a little area right here, but it's not that significant. So depending on where we're gapping, we may be able to rally all the way back up. So we have to assess again the size of the gap up, where's pre-market support or resistance, right? Where are we looking to take action. So we need to ask ourselves these questions. Is yesterday's end of day trend extended? Right? If we had an extended move, right, that may lead to a more neutral open the following day. Are prices opening at support or resistance from the prior day or pre-market data? That can give us a bias as to what the initial direction of movement will be. If we're gapping into support, well, then we want to be looking for buyers to step up there, especially if we're continuing from a prior uptrend. What is the pre-market trend? Does it confirm the trend from the day chart? Is there room to move higher? Do we have any trader pivot lines nearby? And we ask these questions so that we can form a bias for the open, and then we're looking for failures in the opposite direction. So if we have a long bias, we look for a failure pattern or failure to bars moving lower to confirm that bullish bias. Now, before we look at the next slide, we're talk a little bit about tick charts or activity-based charts. A tick is the smallest up and down movement specified by the exchange. So for YM, a tick equals a point. For the S&P, a tick equals a quarter point. It's the smallest incremental move that that particular market can make. So each bar of a tick chart contains the assigned number of ticks that we apply. So if we say, I want to see a 100 tick chart, it's going to have 100 ticks per bar. A 50 tick is 50. A 250 tick is 250 ticks per bar. The key with tick charts, just as any other time frame, is to realize that there is no perfect number. It's whatever number you as the trader feel most comfortable with. That's all it is. Now, with these tick charts, one tick could contain 2 contracts, while another could have 50. So there's a single 100 tick bar. It could be 300 contracts. It could be 75, as it says here, depending on how active it is. But what we want to use, right? I like to use tick charts pre-market, right? Because it consolidates the amount of information. Because it's based on activity and not based on time, it's going to give us more complete looking pictures. So here, pre-market, we've got a 5-minute and a 100 tick. The 5-minute, we see a lot of incomplete data because it's based on time. But the 100 tick shows a much more clear, tradable looking pattern. Why? Because it's based on activity. So it consolidates all of this information into activity rather than time. So it's compressing it, making it more readable. And that's why I like to look at a 100 tick chart before the open to get an idea of the overall trend pre-market. Now, combining the overnight trend as well as the support and resistance and patterns are going to increase the odds of successfully fading the gap or trading in its direction. We need to combine the overnight data with the data from the prior day. That's going to give us a more well-rounded bias as to how we want to be approaching the open. So here we have on the right or on the left just the day chart. You can see a gap, an excessive gap up, right, which creates a void back down. And like I said, the bias with E-mini traders, right, and gaps is to fade them. So with such a large gap up and the first 5-minute bar being a decisively bearish bar down, right, it tells us that supply is increasing. But if we look at the 5-minute 24-hour chart, we see a breakout failure. So that breakout failure in alignment with the excessive gap up and void below on the day chart, it has these 2 time frames in alignment with one another. Breakout failure on the 24-hour chart increases supply. The gap up and void below on the day chart has traders thinking bearish. So these 2 time frames, like I said, are in alignment, and we want to be looking to fade that gap. There's no support on the day chart. There's no support on the 24-hour chart to prevent the markets from falling. All right? Here we have a 2-minute day chart and a 100 tick. The gap up here, again, creates a void. We can see that the prior day was an end-of-day base. You can see that right here. Right? But we get an excessive gap up. We get an excessive gap up, and this gap up creates a void. The first bar closed with a topping tail, almost on its low, telling us that supply was increasing. But the next bar closed with a bottoming tail. If we look at the 100 tick, we'll see that, right, from looking at this pre-market trend, right, look at the time here, around 8:30 and on, the pre-market trend was up. Right? So then there were no failures here. Right? It pulled back to support. So there was a buy setup with very bullish internals here. So this was actually a long opportunity, and that's what we were seeing on this 2-minute. It was setting up a long in alignment with the pre-market trend. And so if we were just looking at the day chart itself, we may not have been willing to take this. But as we combine the day chart with the 24-hour chart, we're able to see that, okay, we've now pulled back into support on the pre-market chart, and we're going to find buyers stepping up here. So signs of stabilization, I want to be taking long. And then we get this move up, and as you can see, what happened up here? What happened there? Right, breakout failure. Yep, exactly. Traders got caught there. And then we started to just go sideways. So there was no follow through to this breakout failure. And we just started to consolidate sideways. Okay, now how do we know the internals must have been very strong on this day? Well, as we go into the market internal section next, this is a combo internal script. And it monitors the internals for us. And when it's this lime-colored green, it tells us that the internals are very, very bullish, very decisive. So that right there tells us the internals were very strong. Okay. So here we have the green star. Here's a 5-minute 24-hour chart and a 5-minute day chart. The 24-hour chart's on the left here now. The pre-market trend is down. Right? We can see that quite clearly. The pre-market trend was down. We tried to move lower, forming a higher low. Then we get a higher high right into major resistance. So this is where we have to start looking to get short. And as you look at the day chart, it was moving up here. It put in a bearish bar at the open. It tried to move lower, and then it came back up. So this, let me just, I want to make this as clean as possible, but this bar right here, this bearish bar right here, is the open bar. That's where we open, right? It's the same bar here. So these two bars are the same. So here's our open. We tried to move lower. It instead begins to retrace. But there was congestion right here to the left, right? We can't see it based on the day chart. But looking at the 24-hour chart, we know that there's major resistance right here to the left. So this gap down, like I said, a gap down creates a void back up. But we've also got room to move lower. So we need to combine the pre-market chart, the pre-market trend, with what's going on with the day chart. And we wait for them to come into alignment. So here on the first bearish bar, there really was no clear pattern. There was no real resistance here on the 24-hour chart. So this attempt to move lower failed. It came back up right into major resistance. That's where we've got congestion. Go ahead I'll wait for your question. Would it have been valid to trade to the short on the 1, 2, 3 lower? Yeah, that would have been fine. The only thing, I mean, I'd like to see the internals, to be perfectly honest. The only thing that concerns me is the size of this gap down to be taking a continuation. A lot of times, like if we just gapped under this resistance and we had a bearish bar down and then an inside bar, I don't have a problem taking that. But with the size of this gap down and knowing that there's always a tendency with E-minis to fade the gap, I'd much rather wait for the retracement. Alright, so we get the retracement. We know there's resistance to the left on the 24-hour chart. So we can be shorting this inside bar here. And then we get this nice fluid move lower. And we're going to look at this area right here on the very next slide. Because as we come down to retest this prior low, we don't know if there's going to be enough bids here to establish a double bottom and turn this up. So we're going to look at a smaller time frame on the next slide to see what was taking place there. All right, Olivia, thank you. But are we all good so far on this slide before I go on to the next one? Like I said, on the next slide, we're going to take an X-ray down. But I want to make sure that we're all on the same page here with this particular slide. No, I mean the only difference is the pattern that you'll see. You'll just see more bars moving up because this is a 5-minute chart. So I mean, it really doesn't matter which one you decide you're going to look at. You're just going to see different pictures. The 60-minute, you would not have been able to get short. And even the 15-minute would have been questionable. That's fine. If you look at them all and you have the 15 set as a day chart, that's fine. Nothing wrong with that. So here we have the 2-minute chart. 2-minute and 100 tick. So if we were looking at the 2-minute, right, the ski bum, if we were looking at the 2-minute, this is what we would see. We would see bullish bars having no follow-through and supply increasing in this area where we know there's congestion to the left. So based on the 2-minute, we'd be looking to short this breakdown. We'll get the bearish bar and then the topping tail on the very next bar. And so that becomes our short off of the 2-minute. Now, as we come back down to retest this prior low, like I said, we never know if there's going to be enough bids to hold the market up. But on the 2-minute, we can get a bit more detail, and we see that it popped up right into resistance, and this bar closed with the topping tail. So based on the 2-minute, we have another shorting opportunity right there. And as you can see, we then that then resulted in a move lower, which makes sense because again, the gap down from the end of day base, the 24-hour chart being in a downtrend, it all supports continued movement to the downside. Now on the 100 tick, we can see now we've got a pivot line up here as well. So a retracement, right? just above this midpoint and right into resistance, but we close on the 2-minute, we closed under that midpoint. So here is the same opportunity, but just off of an even shorter time frame. Retracement into resistance. So here, like I said, is the next opportunity to short, and then we get a nice fluid move down. And we even get a push through this S support line. Can't really tell if it's the S1 or S2, whatever it is. And as you can see, we start to stay below that pivot line now. Once we get below it, we see sellers stepping up here, resistance continuing to keep prices lower. And so again, different time frames give us different pictures. That's why we want to look at not every single time frame, but the ones we're comfortable with. And we're beginning to put a more complete picture together. We've got on the upper two charts, on the upper right a 5-minute day chart, the 2-minute day chart on the upper left. And then we've got 24-hour data on the bottom left and right. So the first two bars that we have on the 2-minute is a little baby bar. Then we break the low of that baby bar, turn back up and close on the high. Right? And it's after a gap down. Right? But the gap down, right, we don't really have very much resistance overhead. Right? So we're saying to ourselves, okay, this has the potential to retrace up significantly because of this void, or this lack of real concrete resistance. The lack of that resistance allows this to possibly move higher. So we get this money bar as it's shown here, and when we look at the 24-hour chart, it was a breakdown failure. So that right there, knowing that we have a breakdown failure on the 24-hour chart, it tells us that demand is increasing. So we can be looking to take this long down here, and on the 100 tick, it was a new low reversal. So then prices begin to move up. The 24-hour chart is beginning to turn higher. The 100 tick is beginning to consolidate here, and we get another push up. Right? Now, as you can see, once we get this push up, it comes into the top of this gap fill area. And that's where supply begins to increase. So again, we have to understand that E-mini traders look for this gap fill day in and day out. Once we got the failure to move lower, that set up the opportunity to take advantage of this fading of the gap down. But without this failure to move lower, I wouldn't be interested in fading this gap. Right? It's the failed breakdown here that prevented this initial attempt to move lower from following through. And that's why we got another push up. And on the 5-minute, it set up a beautiful PSS into the gap. Right? Remember what we said about how many bars moving into the gap as an indication of what's likely to happen. Here we had several bars on the 5-minute moving into the gap fill and then a topping tail. Right? That's our signal to short. So while this would have been an opportunity to take advantage of, we still need to be looking for that gap fill to provide resistance and an opportunity to get short. Again, doing the same thing. 5-minute, 24-hour chart is just going sideways as we approach the open. And then begins to break down. We see this right before the open. We see that prices are beginning to break down. The 100 tick is falling, right? After going sideways, it begins to fall and is now under the daily pivot. The 2-minute or the 2-minute day chart rather, we can see is a breakout failure. And we got a little inside bar, and it's also this inside bar, these arrows all indicate the same spot on each of these charts. So we know that this 2-minute little inside bar after the breakout failure is just under the daily pivot. Right? We've got that daily pivot right here. So when we're able to get a breakout failure and then prices stall under this pivot line, that becomes an opportunity where we want to be shorting. And the 60-minute, right, was an end-of-day move right up into supply. It was an end-of-day move right up into a gap fill, and resistance or sellers were going to get more aggressive there. Is this all making sense? You guys aren't asking very many questions. I want to make sure that I'm not losing anyone. All right. Here we just have a 5-minute chart. Just a plain old or actually rather a 2-minute chart. It's a 2-minute chart, and it's just a day chart, not a 24-hour chart. We can see that at the open, it was real choppy. We had attempts to move lower that failed, attempts to move higher that failed. It was all choppy. Here's a little mini failed breakout. So prices after that failed breakout, prices then begin to move down. They break down under this prior support, and they also poke under the low of the day. Here's the first attempt to move up. Really a very minor retracement. It tries to move lower. We then get a second move up, right? This bear flag pattern. We get this bear flag and double top. That's where we want to be looking to get short. That move takes us deeper into prior resistance, and we see supply increasing. So the second high reversal up here worked well. The first one, like I said, it was just a little minor retracement, a little close to the prior low, but still a trade that we could have taken. We could have taken that. But once it closed with that little minor bottoming tail, and then the next bar, a bottoming tail closing up near its high, we can't ignore the message there that the pattern's not following through. So we get out, and then we reassess. As this next push up couldn't follow through either, and we started to see that this supply was building in the double top form, there's the second attempt, there's the second opportunity short, right there. And you can see that we then got a more fluid movement to the downside. So the gap down was never filled, right? There were attempts to move up and fill it, right? But it never did fill. And then price broke lower. And so when there's attempts to move lower and fill a gap or attempts to move higher to fill a gap that aren't following through, it's telling us that there's a more bearish environment out there. And we're likely to continue moving lower. And based on the way in which we moved lower, there's likely that there was a void down here as well, and that the larger time frames were in agreement. And that is what we look to do every single day. So we're always going to consider the pre-market support and resistance when trading the open. If it's close by, odds are there's going to be a reaction to it. Right? So one of the things we want to do is mark off the pre-market support and resistance levels. This way we know how close are we to those areas, and that's going to help to indicate to us the likelihood or lack thereof in fluid movement. So again, we need to mark these areas off because there will be an effect on them. Right? And it will impact the market's ability to move in one direction or the other. Okay? The best odds of fading a gap or going with it is going to be when the pre-market and the day chart are in agreement and they've both got void. Right? That is going to be when the highest odds of opportunity exist at the open, when they're both in alignment. If one is in an uptrend and the other's in a downtrend, odds are there's likely going to be some chopping around until a failure pattern occurs to bring these different pictures into alignment. Okay. So we're up to market internals now, and we're actually doing pretty well on time. So what we're going to do now is we're going to take a 10-minute break. Get a drink of water.